It's a closed-ended investment trust listed on the London Stock Exchange. Main market. It invests in Indian equities, but particularly small and mid-cap.
The India Capital Growth Fund is different from other funds investing in India because it invests in small and mid-cap stocks quoted in India, whereas most of the other Indian funds will be really focused at the higher end or larger market cap companies. We believe that this gives our investors access to some of the growth that's available in the domestic markets of India, where we think that some of the most exciting growth opportunities exist.
We tend to hold between 30 and 35 stocks. We don't want to hold more than that. It's quite hard to track those stocks with the kind of level of detail that we want to. So any more than that, you're starting to kind of lose focus a little bit, and we want each stock in the portfolio to be relevant and there for its own merit. The turnover is below 15%, which means that holding periods are generally between 5 and 6 years. The team's been together since 2010-11, and the key point of differentiation for us is not just the fact we focus on small and mid-cap, but also that we have an active and experienced team of portfolio managers and analysts on the ground in Bombay. And we're very proactive in our research. So we will visit companies frequently, and very often we will track them for 2 or 3 years before we actually make an investment, either because the price isn't right or because we're not fully comfortable with the story. And our idea really is to know our companies better than anyone else.
India is very different from a lot of the other emerging markets, not least because the market has a plethora of companies across all sectors of the economy. So, for example, some emerging markets you see a lot of focus just on commodity stocks, for example, but India provides a far greater choice for that. The other thing to note about India is that the population is growing. So some of the other major emerging markets are beginning to see population growth very slow or even possibly declining. And I think that sort of gives a different dynamic or different potential for growth looking forwards.
If you go back in time, till the early 90s, it was a very closed economy. There was licensing, you had reservations, and a lot of government control across sectors. So it was only in the early 90s when we ran into a balance of payment crisis that the governments were forced to open up the economy. And since then, it's been 2 decades of really continuous opening up the economy, not just allowing business to flourish without any controls, but also the capital markets were opened up. So capital became slightly more accessible. Today you have economy which was informal but very entrepreneurial moving to really a formal economy. And what you'll see in the future is the second round where it's becoming a level playing field.
Prime Minister Modi was the first Prime Minister to have a working majority in the lower house of Parliament since the early 70s. He's rather like a chief investment officer or a chief executive officer who's got an underperforming business and he's starting to turn it around. So we think the combination of good macro and supportive political environment is going to filter down into kind of strong corporate earnings growth, and we want to capture that.
Well, our investment approach is very, very structured. On the one hand, we spend a lot of time on the ground meeting with managements, but more importantly, our diligence process really is in the sense that we always look at the history. And for us, the last 10 years is the best judge of how our business is. We spend our 2 key parameters on what we look at. From a business perspective, it's cash flows, which is king for us. Businesses which do not generate free cash, historically have not done it, we will not look at those businesses. The second very key aspect for us is management quality. We pride ourselves of picking businesses where we pick the best of the managements, and that's where our diligence really is, that we spend a lot of time on picking the winners for the future.
We have been in this business for over the last 4 decades. We have 3 manufacturing units spread across 2 states of Andhra Pradesh and Telangana. Currently we have 4.3 million tons of cement installed capacity. With adding up of grinding capacity in Bayavaram, which is close to Vizag in Andhra Pradesh, we are doing a 1.2 million tons additional capacity there. By end of September, we should be reaching close to 5.75 million tons installed capacity.
Sagar Cement is one of the, I would say, a very small cement company in India. But it's a company which is extremely well managed, a very, very passionate promoter who's running the business.
We have been a very consistent growth player. We have not been excited with what's happening around. But what we have been very conscious is looking at the balance sheet, and we have been fairly consistent in our delivery to our stakeholders. I think that would be a major USP for us if one has to look at investing in us.
What he's done is, though he's got a small plant, it's an extremely well automated plant in the country, and now he's gradually expanding, and the intent is that he'll almost double his capacity in the next 5 years. He's already moved from 3 million to 4.2 million tons, and he's really addressing all the challenges of logistics and power costs, which is the 2 main cost structures in the cement industry.
Right now we are sitting in the mother plant. It's located in Matampally. It's in state of Telangana in India, southern part of India. The plant visuals that you see actually capture right from our mining all the way up to the dispatch. This is one of the facilities in India which is reasonably sophisticated. We use new generation robotics which is used for quality control. We also have scanning electron microscope, which is very useful for us to look at the end product and try to make sure that the end consumer gets full value for what he pays when he buys our product. We end up using every bit of material what we mine, and at the same time we don't compromise on the end product.
The industry itself we really like because it's really a direct feeder into the infrastructure space in India, where we are very positive of. But what happens with the cement industry is that it really takes you out of the dealings with the government. So the industry actually generates a lot of free cash, and it rides piggyback on the growth in the infrastructure space.
We believe that the demand for this product is actually coming from most of the infrastructure spend, which is directly aligned with the GDP. And with India growing close to around 8%, we believe that demand would sustain us to grow even from where we are to the next step.
Samarthan Motherson Group is a company which has about 400 companies in its portfolio. We are primarily manufacturing automotive components. We started off in 1975 between my mother and me. That's why no rocket science there. The name was Motherson. We started with 1,000 rupees, which approximately is about $14 in today's currency rate, and built up the business from trading house into manufacturing of wires, and then into automotive. We tied up with Sumitomo way back in '83.
Mr. Sehgal, I would rate as someone who's really created this out of nobody. It's a relatively young company by Indian standards, and he's built a business where you have low employee turnover, a lot of R&D going in. He works with any new model which comes out in a car. They really work with Motherson over it. So it's really, he's part of the whole building process of any vehicle coming out on any platform.
We have about 1,800 different components. We're also known as the not yet company. So if you ask me, Chanda, you're making this component, and if I'm not making it, I'll tell you not yet, because Motherson doesn't know how to say no. So we make wiring harnesses, we make interiors, we make exteriors. We're probably one of the largest mirror makers in the world. We do a lot of things in metal, machining, you name it, we do it.
Motherson Sumi today, I would say, is rated among the top auto ancillary companies globally. It's virtually a supplier to auto parts across virtually every company. Very strong in Europe, building a business in the US, and of course within India itself is also very strong.
Turnover is about 12%, something of that is in India. But if you take Raydel, which is the last acquisition that we have announced, it probably will come down to 9-10%. So we have a clear focus, no country, no component, no customer, more than 15% of our turnover. We are being asked to do more and more components by the car makers. So really a particular country or a particular growth rate of GDP and all that don't make much of a difference to us. Whichever is very precious to the car maker, they ask us, we go, we look at that particular thing, and if necessary, we take it over.
This is where the really strong global growth is taking place.
Our dependence on oil is a big issue, that we import over 70% of our oil, and if oil prices go through the roof, then we have a lot of macro concerns coming in which hit inflation, the currency, and that leads to capital flows.
But the government has also done a lot in the last 3-4 years to try and improve the fiscal health of the country, and that's reflected in increased foreign exchange reserves, a stable currency, and structurally lower inflation. So positive macro, and alongside that, a political environment that again is very supportive of growth.
India is very different from China. For one thing, India's way earlier in its growth cycle, in its development cycle. So I think if one was to compare the income levels of people in India, they're probably about 20% of those of China. So India lags China in some ways, but it's developing fast, and there's a great deal of growth in India. It's a very different place, very different politics, very different shape of economy, very different bureaucracy, and very different ways of getting things done.
So if you're thinking of investing in India, the key story is the compounding machines that we have, and there are a lot of such businesses which will keep going at 15 to 20% per annum for several years to come. It's just that you have to play the right portfolio which has these businesses.